Hello, welcome to the live stream. I'm Albert Liu, along with Rick Rule at ruleclassroom.com. This is the online community for natural resource investors. Today is March 12th, 2026, Rick, and there is a lot going on. But first off, how are you doing? It's good to see you again.
Life is good. I'm just back from the Prospectors Developers Association of Canada, the largest mining conference in the world, where I guess I had 90 conversations that I remember in 4 days. There's 30,000 people there. Wonderful circumstance, exhausting, but the truth is that with 30,000 people there from over 100 countries, I probably saved myself 50,000 air miles. So
That's right, Rick. And now put this in perspective for us. You've obviously been going for many decades. Anything stand out as different this year?
first of all, the attendance was huge. I mean, really, 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 truly huge. It was packed. The second thing that stood out is that the industry itself, no surprise as I'm aging, is getting younger. There were people from more countries. There were many, many, many more female professionals there than in years past. And I would say the other thing I came away with that was a positive is the gradual transformation in terms of professionalism among the staffs of the better juniors. There has been a big enough junior industry for a long enough time, well enough funded, diverse enough that the quality of the management teams over 30 or the 30 or 40 years that I've been going to PDAC is almost immeasurably higher. That was good. The bad news is that I wasn't merely competing with smart money at PDAC this year. Had I written checks, I would have been competing with dumb money. There was a lot of money on the floor, smart money and dumb money. I've learned at age 73, when you compete with dumb money, you're dumber yet. So out of 90 meetings, some very brief, mercifully, I'm embarrassed to say I came away unable to write one check, which probably tells you something about if maybe it tells you that a 73-year-old is too cautious, that he's lost the plot, or it tells you that the pricing levels in the speculative side of the market are ahead of themselves in the near term. I would prefer to think, being a 73-year-old, that it is the latter that is true rather than the former.
Very interesting, Rick. A comment about your observation about more female attendance. I assume this is across the board, meaning investors, executives, as well as technical staff. And in my own experience, the large cohort that I went to school with, sort of in the mid 90s, well, they have 25, 30 years experience now. So I would expect that you would see that across the board.
That's true. And I mean, 30 years ago at PDAC, to be honest with you, if there were women there, they were booth bait. You know, they were in IR roles. Now there are women investors, women analysts, female portfolio managers, female geologists, female engineers. If you assume, which I think is correct, that at least half the IQ of humankind is female, the idea that the mining industry has decided to broaden itself from, some would say, half the population base, others would say, because it was largely Caucasian males 30 years ago, 4% of the world's population base. It makes absolute sense that we'd have better outcome if we exposed ourselves to more talent, which we've done.
Um, ask viewers to excuse the distraction here, but I want to ask Rick a question about Berkshire Hathaway, because you said in your last trip out you were discouraged that you didn't write any checks. Um, Berkshire Hathaway, I think, didn't write very many insurance policies last year, and that came through on their operating revenue or their earnings. And it's still Ajit Jain writing the policies. And I think, this is not that they took a huge charge for bad underwriting, but instead that they're trying to maintain underwriting standards in an environment when lots of capital has rushed into the sector. Am I correct on this, Rick?
I think that's right. For a while, Berkshire Hathaway had the only balance sheet in the world that was capable of taking super cat risk. There are people taking super cat risk now that might not be able to afford the super cat risk. And there are people who are writing super cat who care less about the quality of the underwriter and more about the coverage. Those people, in the event of a real super catastrophe, might be very disappointed to learn that some of the people in their syndicates can't pay. That notwithstanding, the participation of people who might not be able to pay has brought down the pricing in many parts of the sector. It's notable that one of the few subsectors that shown growth in the Berkshire Hathaway portfolio is super catastrophe associated with deep water offshore oil and gas. In other words, oil and gas is still such an unpopular investment destination that the flood of capital into, in particular, the super cat sector hasn't extended yet into oil and gas, or for that matter, coal. I'm not sure that Berkshire Hathaway's writing coal indemnities and coal bonds either. Warren Buffett was a little more woke than he liked to let on, but we'll see.
Okay, and one more topic before we get to the events of the week, and then later the main reason I asked you to come on is performance evaluation. I want to get your thoughts on what's going on in private credit right now. Rick, there's just watching the headlines and watching the actions of players like JP Morgan and whatnot has drawn me into this discussion. What are your thoughts on what's going on?
Well, Albert, you probably remember me from time to time belly aching over a beer about the fact that I was being priced out of private credit too. It used to be in the sub-investment grade mining finance market, as an example, that while the credit facilities that we wrote looked like 12%, they were really 18%, which for a well-selected portfolio of risks is probably correct pricing. I see that stuff going out now at 11, which tells me a lot of things. What it tells me in particular is that too much capital is crowded into the space, and there's too many tourists in the space. There are people that are writing facilities that don't know enough to write economic facilities. I use mining because it's the one that I have the experience with. When you look at the deployment performance, the guys that have been in private credit for a very long time, Ares Capital, Gladstone Capital, they have pretty solvent portfolios. They're writing, they're not taking rate downs. It's the new guys, it's the tourists that came into the space, the institutional guys that raised a whole bunch of money from some dumb pension funds that had no experience in the space but wanted access to the yield. It's those people that are experiencing the problem. That doesn't say that the problems won't spread. We have gone for a very long time, Albert, since we had the last recession, since we had the last time that tested the ability of solvent companies to access liquidity. It's been a long time since we had any circumstance other than a good circumstance. And if we have a bad circumstance, even the veteran players will feel hurt. But the people who've been hurt in the last 90 days are by and large people who came into the sector in the last decade. Those whom I describe as tourists in the sector. I welcome more turmoil. Private credit, other than perhaps reinsurance, is my favorite of all businesses. and I've been effectively priced out of my favorite business by these tourists. So I'd love to see them get hurt. I want to talk about one other thing that I've brought up, Albert, which is a lingering fear that I have. I think I've discussed this with you privately, but probably never to the rural classroom. When I think about the things that could go wrong, uh, leaving out war, when I think about the things that could go wrong in the market and seize the market, when I think about the black swan, credit is to me that black swan. The proliferation in corporate credits for below investment grade issuers on conditions and covenants that were written by Wall Street to favor the issuer rather than the lender. And in particular, Albert, what scares me is the proliferation of high yield exchange traded funds, ETFs, where ma and pa investors who don't know about the credit risks they're running buy these products because they're chasing 200, 250 basis points in extra yield without understanding how much risk they're encumbering themselves with. My specific risk is that there's a couple $1 trillion worth of this literal junk, and it's held by very unsophisticated people. And although the ETFs are extremely liquid, the underlying securities that constitute the assets of these ETFs are very illiquid. This is the recipe for a bank run. If there began to be a continuation of the contagion that we've seen in private credit, and if nervousness about credit quality extended to the mas and pas, and they began to redeem, while the ETFs are liquid, the managers would be forced to sell very illiquid securities to fund redemptions. You've heard me say before, Albert, when you call your broker trying to sell a bond that's an illiquid bond, it becomes an owl bond. Because when you ask your broker to sell, he says, to who? To who? And the idea that we would have these incompatible liquidities at the ETF level and at the asset level really scares me. Really,
I
really.
think
Part of me would
aren't
like
we
to
already
see it
seeing
from a distance.
restrictions on redemptions in some of these products? And
They
like you
would,
said, the
I think
risk
they
of
would have to gate them.
yeah,
And I think gating them, I'm not saying would, but I'm saying that I think gating them could generate a 2008 style market seizure.
right. I think it's already
Where,
creating a queue for the next opportunity to get out, right? So lack of liquidity creates
right,
demand for liquidity.
right.
Yeah, it's not surprising. A lot of really good equity investors pay a lot of attention to these credit markets. I guess
Right.
it's not a coincidence. Okay, let's finish with what's going on in the Middle East, Rick. The market now appears to be just trading on headlines, and
Right.
a lot of those headlines they're not even reliable headlines like the post we saw out of the energy secretary's office saying that there were naval escorts of oil vessels. That turned out to be false. So everyone just is scrambling for information, trying to get an edge, but really doesn't know what's going on. So I don't really want to talk about that. But what I want to ask you, Rick, is how does what's going on, if at all, right now impact your sort of central investment theme? Has anything been compromised, or has it been bolstered, or are you just proceeding as if this eventually will blow over and we will be back to the investment theme you had all along?
The truth is, Albert, I don't know. I'm not making investment decisions based on the news because I don't know how to analyze the news in any way that gives me any durable competitive advantage. You and I talked in the classroom 9 months ago about the fact that the oil industry couldn't take a supply shock because they've been underinvesting in sustaining capital for a long time. I didn't say that in intention, pardon me, in the intention of forecasting a Gulf War. It was just the truth about the oil industry. Taking advantage of it in some fashion that would be short term suggests not so much knowing about the oil industry as being a political analyst or a military analyst. And I am neither. So I'm doing neither for a whole bunch of reasons, mostly to do with humankind. I'd like to see this thing fix itself somehow. Uh, You see, on the one hand, commentators saying that the war was effectively over 9 days ago. I hope that's true, but the headlines I read don't suggest it's over uh, or will go over. Pardon me, will be over. So I'm, although I acknowledge that lots of things have changed, my knowledge about what has changed and why and what it portends is insufficient for me to act. What I probably should be doing is I probably should be selling some of the oil stocks I bought. I bought them predicated on hate. The consequence of that war is that the hate is dissipated. The difficulty that I have with that is that although I suspect the oil companies will sell for substantially less 2 or 3 months from now if we have peace, I still believe they'll sell for more 3 years from now. And
Right.
so this
That's sort
deployment
of what
thing,
I was getting at. Yeah,
yeah,
the central theme is still on then, right?
for me, yeah. I mean, I'm reasonably certain that if we solve the problem in the Gulf, that the oil prices would decline back into the 60 level or maybe even into the high 50s levels. And I also believe that late 2028, 2029, irrespective of war, that we'll be back in the 85 and $90 level. So how do I play the game? I think that really has to do with the pricing that the market gives me. Uh, I didn't until 2 weeks ago have a portfolio of speculative oil stocks. I had the biggest and best of the best. I had a couple of the royalty companies, and I had a package of 9 Canadian mid caps that I owned on a valuation basis. And my suspicion is that while that whole basket of stocks may seem expensive 3 months from now, it'll seem cheap 3 years from now. So my current inclination is to do nothing.
All right. Thanks for that. Let's get to the main topic then, Rick. Uh, One thing I learned, well, a couple things actually. The first lesson I learned from you was to never confuse a bull market with brains. I think that's absolutely the most important lesson. But the other thing I learned, maybe number two, was that when you're right on a thesis, an investment thesis, but you've had to wait a long time, when you take into account the cost of capital, that's another way of saying that you were wrong.
Right.
Um, and that is actually relates to a lesson I learned from Joel Littman in his equity class, and that is a lot of times investors really don't look at their real returns, their long-term annualized sort of compounded returns, which is what is really important. And in my experience with you, having worked, at Sprott, having been able to have conversations with and observe investors, like other speculative investors, natural resource investors are enamored with the double, the triple, the 10 bagger, and they often don't look back at their portfolio and consider how long they waited for that, what percentage of their portfolio that represented, and ultimately, like what equivalent annual gain that they're getting, so that they could compare it with either the risk-free rate or the S&P 500 or whatever. So I want to have a conversation about that, and maybe I'll just give you an opportunity to set it up with some remarks, and then I'll ask some specific questions.
Well, I think this is going to be a great conversation. I hope the audience likes it because I know I will. This goes to what I've tried to help investors and speculators with for 40 years. And it's probably a discussion that you and I should be having every quarter to, if not refresh the audience's mind, at least refresh our own minds as to what it is we do for a living. And I think you got most of the question, but I think you forgot something too, which is to say, how hard did you have to work? Uh, there are any number of speculators who I have known in my life who have been extraordinarily successful in their own businesses, who have spent so much time on speculation that they likely would have made more money had they spent that same time and attention on their own business. Because to be a successful speculator, and I'll draw distinctions later about speculation, to be a successful speculator, you have to work very hard. The amount of information that you need to generate yourself or from sources that you seek out means that you have to spend a lot more time and attention on a $250 million market cap company than you would on Exxon, because there are other people who reliably can do that work for you on Exxon. The amount of money that I personally have spent analyzing Exxon in the last 12 months is probably, I don't know, 3.5 hours listening to conference calls, reading financials. The amount of money that I spent on one speculative position that will go unnamed 2 weeks ago, deploying a lot less capital, I probably already have 15 hours in that. And when people talk about return on capital employed, they also need to consider the return on intellectual capital employed and time employed. I think it's important too, before we enter into the totality of this discussion, to understand that investment outcomes are always personalized. And I like to classify my own investment portfolio as having four buckets. I tried to do a little visual aid about a minute ago, which may not show up on screen. You can tell me if it does. Can you see that pyramid?
Let's see. Let's see if we could do better than this. Hold on for a second, Rick. Hold on. Hold on. Yes, it's a pyramid.
Okay.
Okay.
And you'll see the pyramid has four little boxes in it.
Yep.
So that's the way I construct my portfolio. The bottom box at the base of the pyramid is what is my savings, my insurance, my liquidity, my come hell or high water money. I have very, very, very low tolerance for risk there, and I have very low reward expectations. I have told myself artificially, probably over 40 years, that my annual return goal, my nominal, by the way, not real annual return goal, which is to say before, not after real inflation, uh, or put differently, my tolerance for a uh, for a drawdown uh, should be substantially higher than my expected decade-long rates of return. So, while I might accept, as an example, 3.5 or 4% nominal rate of return in the insurance or savings function of my portfolio, I would be willing to anticipate, in terms of that class, a 6% drawdown on a short-term basis. As an example, a substantial part of my own court portfolio, in addition to dollar-denominated short-term savings instruments, is gold. The fact is that gold as a savings product has served me extremely well since the year 2000, but it's exposed me to a hell of a lot of volatility. So I hope people understand that. I have low aspirations for return, high aspirations for safety, and a relatively low tolerance for variability or fluctuation. I consider the second box up from the bottom to be my core investments. They're nowhere near as safe as my insurance or savings investments, but they are investments that I believe will earn me a high probability of reasonable returns on capital employed over time. Uh, those businesses may be private businesses that are well capitalized that I operate myself. They may be names that I consider to be sterling names, like Franco Nevada, Wheaton Precious, Exxon, names like that. They are normally extremely high quality businesses where I feel I have even more than adequate knowledge, that are well capitalized, conservatively managed by honest people, and businesses that I'm very familiar with. I might expect in my core portfolio annualized rate of returns of between 8 and 10% compounded. In which case, by my own standards, I would expect annual fluctuations, annual drawdowns, non-repeatable, but not infrequent, of as much as 15% of the value in that box. The next box would be growth, which is to say not core, but companies or investments where you expect greater than average returns but where you're taking higher risk and you're tolerating more variability. My investment in Sprott was a classic growth investment, not a core holding, to be sure, one where my return expectations were higher, but where I was taking more risk, and where the volatility and variability of the stock was such that I had to weather some extraordinary 25% as an example, periodic drawdowns. The fourth box at the top, the tippy top, is speculation. Uh, this is where, rather than allocating capital with the probability of adequate returns on capital employed, that you are allocating capital against the possibility as opposed to the probability of very large returns. And in this, in order to take the risk, you need very, very, very high returns over time, and you expose yourself as a consequence to extraordinary volatility. In my speculative portfolio, I have always looked at return expectation of 35% compounded on an annual basis, which means that I have tolerated and have experienced, by the way, 50% annual drawdowns in my speculative account. The fact that I generate, hopefully, 35% compounded over a decade is a very good return, but it exposes me to having some periods where, as opposed to a 35% positive return, I have a 50% drawdown. And when you are using what used to be called the financial planning pyramid, which is to say that ugly little graph I just drew for you, when you look at all three, or pardon me, all four, really, of the components of that pyramid, you have to consider within those expectations allocation, which is to say, if the speculative part of your portfolio experiences 60% allocation during the period of time measured, then the return expectation has to be tempered by deployment. If you have been able to deploy your speculative capital only 60% of the year, your return expectation for the year has to be 60% of 35%. Many investors, particularly traders, who don't take into account the periods between deployment, the cash drag that occurs, have unnecessarily inflated views of the returns that they have or expect to enjoy. Albert, I'm sorry for that long-winded sort of discourse, but I think it's a necessary precondition for the rest of our discussion.
I think it's great, Rick, because I think you you answered basically my leading questions, and so everything for me that comes after this is a bonus. I just want to comment now on some of the things that you said. That was a great point about how hard you're working for the return, and the way I've seen it in my personal life is the sort of the amateur landlord who thinks he's great, getting a great return, but he's spending all of his nights and weekends chasing after tenants, doing contracts, fixing toilets, so on and so forth. And then by the time you figure out what their unlevered rate of return is on capital, it's not as good as my 10-year treasury. and then they have to do all that work too. So that's a great point. And then
Albert, I'm laughing because I was just chopping firewood this weekend. If ever there was a dumb pastime for a 73-year-old credit analyst than chopping firewood, when there's plenty of folks around who will do it for $25 an hour. I was laughing because your joke was on me, I guess is what I'm saying.
Well, no, because that's a leisure activity. I'm talking about people who would much rather be spending time with their kids and instead are fixing toilets and doors and windows and whatnot. And then your discussion with the pyramid sort of answered my question about sort of risk-adjusted return. So let's start from the bottom and go up. So you said the bottom, you're talking about, I think you said 3 or 4% return and double that in terms of maximum drawdown. Is that what you said?
What I've artificially said that in terms of my planning for the year, I expect the possibility of 150% drawdown relative to my expected annual rate of return. If my expected annual rate of return is forecast over a decade, which, by the way, it's going to be wrong because things are going to change, then my portfolio allocations have to be based on a tolerance for a drawdown in that category that's 150% of my return expectation over a decade. I should note, Albert, that those numbers in my model are nominal returns. That's important, particularly the bottom of the pyramid, because my return expectations at the bottom of my pyramid right now are 4%. I'm doing substantially better than that because the gold is doing substantially better than that. But I point out that simply because I believe that the deterioration of the purchasing power of the capital I save in, which is to say the dollar, is declining at 8% compounded. So to believe I'm actually getting 4%, well, I am actually getting 4% in a currency that's declining by 8, tells me that my real rate of return is negative. For me, my negative real rate of return isn't negative because I've tried to offset the negative real rates of return I get on deposit products by holding gold. But it's important to note that when I talk about the return targets, they are before inflation.
Right. Right. And that whole framework sort of presumes that the unit of account is the US dollar, right?
And for me, because that's what I spend,
Right.
it is. You and I have talked about the fact that if you both save in gold and then maintain a separate ledger in gold, in the period 2000 to 2025, you become struck by how cheap things are.
Right.
If your frame of reference is the US dollar and you look at Carlsbad real estate, you think, boy, is it expensive. If you look at Carlsbad real estate in gold, you think, boy, it's cheap.
Right. Yeah.
So
Yeah.
it is.
If instead the unit of account were gold, the criteria would be very different. You wouldn't be looking for a 4% nominal return. You'd be, I mean, it's not a credit instrument anyway, but I guess if you could make it a credit instrument and then the inflation premium would not be in your nominal return, you'd be talking about real return.
That's correct.
Okay, so that's great. So then core holdings. So under core holdings, you're willing to put companies like Franco-Nevada. So our the royalty streaming companies, would you put gold producers in that category? Who else gets to fit in that category? ExxonMobil? What kind of companies would you put in there?
I have Agnico Eagle there because their long-term track record. I have Berkshire Hathaway in there, although I need to say two of my reasons for owning it are challenged. Buffett isn't allocating that capital anymore. And the cash drag is beginning to moderate my return. It increases my safety if I believe that Abel can allocate the capital efficiently. But I'm beginning to question the inclusion of Berkshire Hathaway. I have included for my own accounts shares in an exchange traded fund called the Dividend Aristocrats. Noble companies that have met or exceeded their dividend guidance for 30 consecutive years. There. Maybe I'm kidding myself. I believe that companies that are profitable enough that they can distribute substantial capital to shareholders and are polite enough to do so over 30 years, if you have a diversified portfolio of them, are probably safe. The fact that I have to use the word probably means that maybe I should be moving that to the growth category from the core category. It's a discussion I have with myself. I also regard the very high quality pipeline and utility companies that are not over leveraged in this. Pipeline businesses are extraordinarily good businesses. You put goop in one end and you pump goop out of the other end. They're usually, if not monopolies, at least oligopolies. And if you have a sufficient amount of goop that you put in the one end and you have a sufficient market for goop that you take out of the other end, the cash flows and the ability to service debt are extraordinarily predictable.
Okay, and did you say that expected return and drawdown was roughly 9% and 12 respectively, or something like that for this group?
Yeah, to make it easy on myself, I said 10. And that means that the annual drawdown that I expect, sometimes I've experienced worse, 2008, I certainly did, is 150% of that. So 15.
Okay, 10 and 15. Okay. Next group was growth.
Yep.
You put Sprott in that category, Sprott Inc.
Yes.
What other companies would you put in that category?
The
How about
whole
let's start with
panoply,
resource companies. Are there any resource companies you'd put in a growth?
the whole panoply of the Canadian oil and gas stocks that I've talked about in the rural classroom. So the Suncors, the Canadian Naturals, the Arcs, the Tourmalines, the Peytos, the Birchcliffs, their returns have been better because their dividends have been high and because I was able to buy them at extraordinary discounts. But if you thought about owning them over the course of a decade, I would hope for a 15 to 18%, perhaps as high as 20% return on those companies, albeit with much greater drawdowns.
Okay, so far we've just been talking empirically about performance and risk. Are there any other factors that you can generalize and say you look at to assign these bins, like credit quality or earnings track record or dividend growth, or is there anything
Yes,
else that we can
yes,
use
yes,
as a
and yes. And with increasing stridency as I go up the pyramid. And that's why you have to add both risk, work and deployment. Um, I have to spend time on my growth companies. I don't spend much time on my core companies. And even if I spend time, I run a greater risk of making a mistake because I have to make active decisions. Uh, my active decisions around Exxon will have everything to do with the oil and gas industry earning 50% operating margins across the board, which tells me the oil price is going to fall. That's kind of all I have to know about Exxon. When I look at Peyto, I have to analyze a hedge book that goes out 5 years that's more sophisticated than I. And that isn't even a speculation yet. I have to work at managing the money I have in Peyto. Now, I happen to enjoy it. It is a pastime for me. But for people who have lives, they need to take into consideration um, that risk, the time that they divert from something that they enjoy or something that earns them a higher rate of return. And then there's deployment. The further you go down the safety pyramid or the quality pyramid, the longer you traditionally are deployed. By definition, you could say the bottom of the pyramid is either deployed or undeployed, which is to say, cash at the bottom of the pyramid is earning returns that have low expectations around them. Cash at the top of the pyramid in speculation is exposing you to a lot of cash drag. People need to understand that too.
Okay, and let's get to that juicy nugget at the top, Rick. This is the most exciting bin.
Yep.
This is the speculative bin. I think you said 35% expected return.
35% annualized return expectations.
But can we clarify? So this includes the cash drag. This is inclusive of the cash drag,
No,
or
that's of capital deployed.
capital deployed. Okay,
And
so
that's what killed me as a money manager, as the amount of money I had under management increased. I was a really good $250 million manager. And as I got up to managing closer to $1 billion, cash drag began to bite. And so people need to understand that when they have return calculations, they need to well, they don't need to, but they should subtract cash drag and deployment risk from that. In other words, if you're 60% deployed in an activity that you expect has a 35% compound internal rate of return, that you do your return expectations by taking 60% of 35% in the period you're measuring. Now, under deployment, to the extent that you hit these periodic air pockets, also reduces your decline. Your decline, if you have junior resource markets that fall by half and you're 60% deployed, the money that you had undeployed, probably accidentally, saves your butt from that air pocket you hit.
Right. Right. So most people are not trying to manage the amount of money that you were managing at the time. So 35%, let's say, is the expected value that you're shooting for. What is the lower bound on that? Like, at what point can we say as investors, and let's put a time period on it. So 5 years.
I'm talking about speculative activity that you understand well and work hard at over a decade. All of
Right.
these return expectations are decade long return
Okay.
expectations.
Okay.
Annualized, but decade long.
Okay. So I mean that's a tremendous track record, right? Trailing returns 35% annualized over 10 years. That's
It turns out in deployed capital, I've been able to do that in speculation. Note
well,
in
that's why
deployed
we're all
capital.
here, Rick.
Pardon me?
That's why we're all here.
Now, that means, I mean, by nature, this thing is spotty. I've had some extraordinary years. If I remember the Exploration Capital Partners 2000, that partnership for 6 years before fees generated 75% compound returns. And I may be remembering it incorrectly, but I'm not remembering it too incorrectly. 70 to 75% compound returns for 7 straight years. There were other circumstances like Exploration Capital Partners 2005. Ironically, something that was very easy to raise as a consequence of the success of Exploration Capital Partners 98 and 2000, that returned after 6 years something like 75% of the cash invested in it.
Right.
So you need to understand before you get too excited about 35% compounded, that you can have 2 or 3 or 4 year periods where your returns are negative. And if you aren't prepared to think about that activity in the context of a decade, you should go down the risk scale.
Yeah, absolutely.
I
Absolutely.
mean, we had a year last year. I mean, anybody who came to the Rural Natural Resources Investment Symposium in 2025 or 2024 and didn't come out making a boatload of money needs to pursue a different avocation. The year that we had in junior resource stocks, mining and energy in 2025 was absolutely one for the record books. I think the activity is going to be rewarding for the next 10 years. But I think people whose return expectations were set by the returns they got last year are going to be disappointed of their own volition.
Yeah. Yeah. Definitely. Definitely. Okay. That helps a lot. That puts a sort of range bounds. It's something I've been curious about for a while because, and I think I wanted to have this discussion now because now we have pretty good performance to discuss.
Right.
So I think it's a great time to have this discussion. I'm wondering if anyone in the comments has questions. There's always questions, but any questions specifically about what we're discussing today, that is evaluating investor performance. Let me see. I don't see anything quite yet. Well, okay. So this is tangentially related. Rick, what kind of news sites do you like to read?
Oh boy. I guess my favorite's Al Jazeera. When I have the time, the difficulty with Al Jazeera is that they characteristically spend 45 minutes on one topic. And if I have the time to verse myself as deeply in that topic, I like Al Jazeera. I like it because they identify their opinion, as opinion. They try, when they take on a major issue, like the current war, to get opposing viewpoints. So they might get the U.S. viewpoint, they might get the Israeli viewpoint, they might get the Iranian viewpoint, and then they tell you what their viewpoint is. The fact that they are willing to spend 45 minutes on a topic, whether or not I have 45 minutes to spend on it, is useful to me. I enjoy, as an aggregator of news sites, Bloomberg. If you have the Bloomberg service that you pay for, you don't have to be as technologically sophisticated as Albert Liu. You can type in news and information, give them a topic, and they have this search engine or something that goes around and they pull news from 800 sources and they give it to you. It's like having your own newsletter on whatever topic you care about, delivered to you every morning, which is very useful. I am told that younger, more technologically facile people than I um, can duplicate what Bloomberg does for free, uh, by being smart, but I'm not. So I have to use Bloomberg.
Yeah, well, AI is coming, Rick. So
Yep.
that playing field is about to be severely leveled,
I'm
if not
counting on you
demolished.
helping me.
Here's a question from John. It's related to something we were talking about earlier. Asking about returns measured in fiat or in gold. Obviously, we have a fiat unit of account. Do you ever pause and just go back and look at your story, your balance sheet in gold, just for kicks to see what's going
I,
on?
I do. I wouldn't say I waste 50 hours a year doing it, but I do. I began saving both in gold and maintaining liquidity in US dollars, uh, at the turn of the millennium at 2000. I tried to change a few things in my life then, including how I save. And it's interesting when I look at the performance of gold relative to the US dollar. And it's interesting when I look at the blended returns I've gotten. It's particularly interesting when you do the thought experiment where you measure the cost of goods that you acquire, like we said earlier, in gold relative to US dollars. I'm not suggesting necessarily that most people save all in gold. I'm not sure that many people could wean their minds of calculating their returns in dollars and hence being elated at some point in time and terrified at other points of time. What you learn is that at the points of time like 2012, 2013, 2014, that the gold massacres you, you get uh, relatively decent returns in the dollar portion of your portfolio. So I'm not sure I can draw any conclusions from that, but it's an interesting thought exercise. Obviously, looking back to the year 2000, even including the down years, and they were ugly, uh, gold substantially outperformed cash. Uh, there are also, it should be noted, people who don't understand gold as liquidity, which is to say they're unwilling to sell it.
Right.
In 2010, 2011, I learned that gold really was liquidity for me because there were opportunities to deploy capital that seemed appropriate in the near term, and I was able to make myself sell my gold and buy those. So I proved to myself, that gold for me actually was savings. I know some other folks who you couldn't pry their gold out of under any circumstances. So those people can't regard that gold as liquidity because for them, given their psychological makeup, it's not liquidity.
Okay. Um, since something has either happened to your camera or your chair, Rick, and we can no longer see the Battle Bank logo on your shirt, so I want to go
Can't
ahead and
have
ask
that.
you.
God, can't have that.
I'm going to ask you about Battle Bank, Rick, because you have sort of uh, you've been granted, I guess, the charter that you were looking for. I know that you were taking some accounts, and people have been asking me actually about when they can start opening their accounts. These are people who are actually on the waiting list. What's going on, Rick, with Battle Bank?
We are looking at the waiting list, which now numbers over 22,000, by the way. And we are selecting from the people who have selected among the goods and services that we offer, ones that we are most comfortable with our ability to deliver service in first. Uh, we are experiencing very rapid deposit growth and pretty rapid growth in our precious metals lending business. We are uh, contacting about 100 people from the waiting list a day. Uh, the fact that after we bought that bank in Minnesota. When we decided to take that bank national, we wanted to test our processes with our own money. You only have one chance to make a good first impression. And so we wanted to make sure that deposits deposited and checks cashed, wires wired. We've done that. Now what we want to do is make sure that we don't get overwhelmed with growth. We want to be able to continue to deliver, or pardon me, we want to establish standards for delivery that we can be proud of as opposed to afraid of. So we're trying to grow until we've tested in um, all of our silos. We're trying to grow measurably.
Okay. How long do you think it's going to take for you guys to work through this waiting list? It's rather large.
Uh, the whole waiting list. One of the things we noted is if you contact 100 people, initially 5 or 6 contact you back. So we're deliberately going very slowly in case the response rate increases, which is something that we're finding from the earlier respondees. So I wouldn't suspect that we'll get through the entire waiting list, particularly those who didn't tell us what it is that we have that they're interested in. I wouldn't suspect that we'll get through all of that in a year. If somebody just said that they're interested in Battle Bank because they heard Rick Rule talk about Battle Bank and they're pissed at their current bank, that won't be as high a priority for us as somebody who says, I really, really, really want to establish a working credit facility secured by my gold, or your high yield US dollar savings account is just what I need. My checking account isn't receiving any interest, which is wrong. I want to get paid interest on my deposits. Or I want to be able, as you suggest, to save in Argentine pesos. I think with Melee, the country is on the road to prosperity, and I want part of my savings to reflect that. In other words, the people who have taken the time to think through what services of ours can benefit them are the people who, by definition, we can benefit the most. And those are the ones we're most interested in helping.
Okay, great. Well, that's great news that this is moving along. It's kind of interesting that we would get questions every week on this until you opened and it quieted down. So I just want to remind people that it's there and they're ramping up. Uh, Here's a question from Helen She wants to talk
Hi, Helen.
about the bottom of the pyramid, Rick.
Yeah.
It says, would be fun to explore more options in the bottom of the pyramid. We know there's gold bullion there. We know there's dollar financial instruments. I assume the highest credit quality, U.S. Treasuries. Is there anything else in there? Commercial paper or what else is in there, Rick?
I've been lucky enough to be able to invest in senior secured revolving credit facilities for investment grade credit borrowers. And so prime rate revolving credit facilities for the Johnson and Johnsons of the world. I don't have that one, but I would include secured on balance sheet obligations of investment grade triple B or better issuers in that. Likely, if somebody had a short term secured real estate note with very, very, very good loan to value, if you stretch it, you could include. I prefer to include instruments with 365 or fewer day maturities.
Okay, now we're opening up the work aspect of this deal, right? If we start doing secured real estate loans and whatnot as
Yeah.
just a retail investor.
I don't include senior real estate loans. I'm suggesting that people who know what they were doing, people who could ascertain value and risk, might include that type of instrument in
Right,
this. I don't, because it's not what
right,
I do for a living.
right.
When I think about the risk that I would have providing cash to the senior secured revolver of Silver Wheaton Precious, or Exxon. Because those are 365-day terms, I don't feel a lot of risk there.
Okay. Okay, great. Let's see. So Paula, let me throw this one up from Paula. Rick, due to the growing oil supply shock from the Iran war and the risk of global recession, does that temper your enthusiasm for oil and gas allocation today? We kind of touched on this, Rick. You want to just revisit that topic for Paula?
The thing that scares me about oil and gas allocations today is that the prices have run up so much.
Right.
I tend to invest in anticipation of a 5-year, 6-year, 7-year cycle. The current crude price is a price that I had expected attaining in 2028. The fact that we got it in 2026 it means that I've enjoyed a lot of the share price appreciation, the oil price appreciation that I thought would accrue to me over 24 months, and I've enjoyed it in 3 months. So I'm not allocating to the oil and gas sector, with the exception of very, very, very small companies that haven't moved very much in relation to events in the Middle East, because they're in unloved sectors, unloved parts of the oil and gas business. And those, by the way, are decidedly in the speculative part of the portfolio.
Yeah, and this is, I guess I can contrast this with prior times when maybe a more speculative investment, maybe that's the difference here, but a very speculative investment would go up, and you would say that, look, if they're going to pay me for the event that has not yet occurred, I'm going to take the money.
That's a great point, Albert. In the type of market that we're in right now, as evidenced by the PDAC, in the speculative part of my portfolio, particularly the exploration part, I always allocated money based on a series of questions around unanswered questions. In other words, if a company had, as an example, surface sampled a deposit, and so they got an indication of the target size, and then they trenched the surface anomaly to show that the gold in soils, as an example, was in situ rather than transported. The next question might be, if you put a string of 10 holes across it, will you be able to prove the target at depth? And most importantly, will you be able to quantify the target? And if I anticipated, as an example, that if 6 of the 10 holes hit and they could indicate a target of 1 million ounces at acceptable grade, that what was currently a $1 stock would likely, in a risk sense, be a $3 stock. If I thought there was a reasonable possibility of that, and further, that would set off a series of questions that could ultimately be a $10 stock, I'd be interested in investing. What happens in a bull market sometimes is that anticipation of the answer gives you 100% of the value of the result of a yes answer. If I get $3 on a dollar stock in anticipation of the yes answer before I get the yes answer, I will always sell enough of the stock to get my money back and pay the capital gains tax. In other words, I get the yes or no for free. Most speculators have a hard time doing that. Most speculators assume in the near term that the market's right. And the fact that the stock went from $1 to $3 validates the thesis in anticipation of information, in anticipation of the drill hole. I love it when I get those opportunities. Unlike most speculators, I take them.
Yeah, and in this case, we're talking in the context where the probability of a yes answer is actually statistically low already.
Correct.
Right?
Correct.
And they're giving it to you. Whereas now, if you look at energy, this falls more into the category of sort of if the cost of the commodity falls too low, below the cost of production, then the price is going to go up. It's more that argument, isn't it?
I don't understand the question, Albert. I'm
Oh, I'm
sorry.
saying that the probability, because you have a 3-year expectation for oil. And what I'm saying is that this is not as highly speculative as some of the other examples where we're talking about multiple drill holes and follow-on
Correct.
pieces to that and all that coming through, the chain of events actually happening. You're more confident about this energy thesis than any of those other examples.
Correct. You'll recall earlier discussions that you and I have had that says that a question where the answer begins with when
Right. That's what I meant.
with
Yeah,
more
it's an easy.
value than
It's the rule is
a
rule of waves.
conversation where the answer begins with if.
Yes,
Uh,
that's if
Particularly
versus when.
when where the question goes to timing as opposed to the answer. Those are good questions.
Okay, we are at the hour mark. Rick, do you have to run off to something else right now?
Uh, Let me
I think
consult.
you do, actually. I think I
Let,
recall from your schedule you did. I just want to quickly mention that we have a copper boot camp next month, April 18th. Go to bootcamp.ruleclassroom.com. This is going to be a great event. We got Professor Stephen Enders headlining again. We have Robert Friedland, celebrated investor, joining us. This is just going to be fantastic. Rick has a knack of scheduling these things just at the right time. So who knows? Maybe this Copper Boot Camp will be another one of those. Rick, any quick words before you have to run off?
I think the probability of losing money in the copper business over the next 5 years, absent a global depression, is very low. We'll talk about the setup in copper. We'll talk about the fact that the mining industry is underinvested in copper for 30 years and isn't going to make up for a 30-year capital hiatus in 5 years. We'll talk about the fact that demand for copper is growing, and not merely because of AI, but rather because 1 billion people on Earth have no access to primary electricity. We'll talk about the fact that at London Mining Week last year, we learned that the major copper producers in the world have to invest $250 billion to maintain their current production. The problem with that is that the current production is at a deficit with current demand, and demand is increasing by 2% compounded. I believe that absent a global recession, that we will have increasing shortfalls in supply, and that the balance between supply and demand will have to be rationed by price. I believe that's a wonderful circumstance. Will it occur in 2026 or 2027? I don't know. Will it occur by 2030? Yes. Will it occur by 2032, 2033? Dramatically, yes. What we hope to do is teach you enough in what we'll call movie parlance to segregate between the good, the bad, and the ugly in your copper investments, and to understand enough about why you made the copper investments that the inevitable cyclicality and volatility that you will experience in copper prices and copper stock prices won't unnerve you. If you have a sense of the value of your investments, the perturbations in price will become less alarming.
All right, thanks for that. And that is April 18th, bootcamp.ruleclassroom.com. Rick, thanks a lot. This was very insightful. Guys, if you enjoyed this conversation, please let us know in the comments or in the classroom. I always enjoy these discussions, Rick. So thanks a lot for your time.
As do I. Thank you for insightful questions. I hope our audience enjoyed them.
All right, take care.